So I'll start with an easy question. What is your forecast for the federal funds rate at the end of 2023?
Well, that's an easy question. So I'm a little bit more, a little higher than the median in the SEP because I see a little more inflation persistence than the SEP. And so I think that's the key point. You know, the committee's path in the SEP, I think, is very valid. We need to continue to bring up interest rates into a restrictive stance. We did a lot of work this year in getting expeditiously to a restrictive stance. Now we're just in starting that, bringing rates even higher. And I think we're going to need to be there for a long, quite a while in order to get inflation on a sustainable downward path. So my path is a little bit stronger than the median path next year. The median had it between 5 and 5.25, and I'm a little above that. But, the message from the SEP is we have to continue to raise rates because we have more work to do on inflation. Inflation, although we've had some welcome news, is still too high, and we need to do what we can with our monetary policy tools to bring it down.
Well, that raises the question of why you and your colleagues raised your forecast for where the inflation rate will be, the PCE inflation rate, at the end of 2023.
Well, we put in the forecast, the last SEP in September, and the accumulated evidence shows that inflation did run a little higher than we had expected it to run this year. So we're starting at a higher level. And so the work that we're doing with interest rates over the next year and the following year is really going to get inflation down. So if you look at the SEP, there is a material improvement in inflation next year, not back to 2% yet, but at least coming down. And then we'll have to adjust policy to ensure that inflation is sustainably down back to 2% after that. So that's what the job of the Fed is, to make sure that we get that inflation moving back down. And that's what our policy path in the SEP conveys, is that we're very committed to getting back to 2% inflation and price stability.
Well, we had two soft CPI reports and a PCE report that was lower. Did that not figure into your thinking?
Well, of course it did. That was welcome news. It's great to see some of those monthly increases move down a bit and temper. But right now, my read is that the evidence just suggests that we see tentative signs of inflation stabilizing. I haven't seen a lot of evidence that service prices have moved down yet. We have some tentative signs that housing, if you look at the rents and new leases being signed, they've moved down. And Cleveland Fed Research says that takes about a year to show through to the CPI and PCE rent part of those indices. So that's a good sign. We've seen goods prices and commodity prices move back down. That's a good sign. But we know that service price inflation is what's really persistent, and we haven't seen much improvement there. So again, the level of inflation is still way too high. 7.1 on the CPI, 6% on the PCE, measured year over year. That's well above our goal, and so that's why we have to continue using our tools to get inflation on that sustainable downward path. And I expect to see some volatility in the monthly numbers. That's why we need to see really consistent evidence and cumulative evidence that inflation's moving back down. We haven't seen that yet, although I don't want to discount the good news that we've gotten in those last couple of inflation reports.
But it sounds like you did not change your SEP inflation forecast after the CPI report on Tuesday.
No, because it was roughly what I anticipated it to be. It wasn't a surprise. We've been saying that we should expect inflation to stabilize and then move back down, and the goods parts of that report was pretty much in line. So again, I didn't think of it as that much of a surprise. I was glad to see that the monthly pace had moved down, but I didn't think of it as being inconsistent with the forecast. It does give you a little more evidence of confidence in your forecast when you see data coming in consistent with it. But, given that we've missed on the inflation forecast quite a bit, and not just the Fed, private sector forecasters did as well, again, we have to be a little bit humble about our forecast and let the data come in and judge what the path of inflation is going to be. That guides our monetary policy decisions.
If you know, as you suggested, that contemporaneous measures of rent are coming down and that it takes a while to get into the CPI, why not just look through the housing component of CPI and PCE and think of inflation ex housing, as Jay Powell has suggested?
Well, we look at all, our goal is in PCE inflation, year-over-year PCE inflation of 2%. But we look at a lot of different indicators because those indicators tell us the direction of inflation. So we have to look at housing prices. That's a big chunk of what people pay for, right? A lot of times people say, why do you look at core? You're taking out food and energy. That's a big part of my basket. And you have to explain, well, our target includes those, but when we're trying to figure out the direction of inflation, where it's going, sometimes food and energy prices are a little bit difficult because they're so volatile. Now, we have inflation high. The goods prices are coming down. Oil prices have come down. But again, we just have to see a more cumulative evidence that inflation has indeed peaked and that it is moving back down. And it's just going to take some time for inflation to get down. We know how persistent it's been. And, we just have to do our work to make sure that inflation is going to get back down to 2%. And that's what we're doing.
One of the things that's confused people on Wall Street is the idea that you, on the Open Market Committee, raised your forecast for PCE core inflation at the end of 2022 to 4.8%, which means you'd need a 7/10 increase in that in December to get there. And mathematically, that's only happened once since 1981. Do you really think we're going to get a 4.8% read?
Well, remember, that's the median of of 19 different projections, right? So you can't say well, that median necessarily is a particular person's forecast. But I think the way I would look at the SEP is inflation has been a little more persistent than we thought in September, and that's why the numbers moved. And if you look at all the numbers, I think you get a better sense of where things are going. So, a little bit more inflation persistence coming down next year, and a material change in inflation next year. And then unemployment moves up a little bit because we're slowing the economy in terms of the demand side of the economy. And that'll also slow some of the labor market indicators. And then we get back to 2% inflation, but it takes a while. So I think that's the way I look at it. Remember, the median path and the median forecast, and there are not one person's forecast. It's a way of summarizing a lot of different forecasts.
Well, to get back to what you said earlier about leaving rates in place for a long time, earlier today, Mary Daly and John Williams both suggested that you're going to have to leave rates in place for maybe 11 months or so. Mary Daly said that's the historical pattern from the peak, but you wouldn't get there until March or May. So we would be well into 2024 at that peak rate. Should Americans be prepared for high interest rates for that long?
Well, I think we should be prepared for high interest rates. I mean, the exact timing of when, it'll be appropriate to, move rates down really is not tied to a calendar. It's tied to have we seen evidence and good evidence that inflation is on that sustained downward path to 2%. So, you can go back in history and look at, how long things will have to be where they are. But we're basing our forecast, and I'm basing my forecast on my projection of where the economy is going to be. So when data comes in, when people say, are you data dependent? I say, yes, I am. But it's the data coming in, and I mean data and anecdotal evidence that we get from our business contacts and our community development contacts in the district. That informs my outlook. And then I base my policy decisions on that outlook. So my own outlook is that we will have to keep the funds rate up above 5% next year, right? And until we get inflation moving back down on that consistent basis. And then we can move into the next phase. So we're really basically done one phase of policy. One phase was, let's get expeditiously to the start of a restrictive stance. We did that this year. Now we're in the second phase, which is we're going to move into restricted territory and a sufficiently restrictive stance in order to get back to price stability in a timely way.
Let me ask you right there, what is a sufficiently restrictive stance?
Right, and that's what the data or the evidence in the SEP tells you, that most people on the committee believe that, I think 17 out of 19 believe that it'll be above 5%. It's going to be informed by both how fast is inflation moving back down, and it's going to be informed by how much is demand and supply coming into better balance, which then alleviates price, alleviates those price pressures that we've seen rise so much over the past year. So that it's data dependent in the terms of, we're going to let the data come in and we're going to have to use that data and evidence to inform our outlook. Right now, our best evidence is, and our models and our talking to our contacts, is that we're going to have to move rates up, ongoing increases from the current rate to above 5%, and hold there for some time in order to get inflation back down to 2%. And that's what we're about doing right now.
Well, let's talk about what you do see in the economy for 2023. The SEP median is for a 0.5% growth, which economists would tell you is basically forecasting recession, because you're splitting hairs with 0.1% growth there. Do you see any contraction in 2023?
So I didn't pencil in a contraction in my SEP, but I did pencil in growth that was well below trend. And when you have growth, as you say, well below trend, it won't take much of a shock to push you into a negative couple of quarters. So I do see growth slowing. But remember, that's part of the mechanism of getting demand into better balance with supply and alleviating those price pressures. And I do see the unemployment rate going up a bit next year as well, again, but inflation is coming back down too. So the mechanism through which monetary policy is going to get us back to price stability does entail slower growth and some increase in the unemployment rate in order to get that balance that we're seeking to get inflation back down and get back to price stability. So I don't want to discount that in terms of the pain. But right now, we're trying to move our policy in the way to get back to price stability, but in a way that minimizes the pain of the journey.
For many on Wall Street, the question after your meeting was, did the Fed underestimate the persistence of inflation, or is this really an effort to try to halt the loosening of financial conditions that's happened over the last couple of months?
Well, so, there's two reasons that the market participants might have a different view than the Fed. One is they don't understand what the Fed is doing. I don't think that's the case. I think we've been very clear. The SEP gives you some numbers attached to our forecasting, and I think we've been very clear and transparent about how we're seeing the economy and where we see monetary policy needing to be in order to get inflation back down. And I don't think anybody underappreciates the fact that we're very committed to getting inflation back down to 2%, and we will do it. I think there can be differences of forecasting, right? The market might see inflation coming down sooner than we do, and therefore they'd have a different view of what appropriate monetary policy is. That's why we're all data dependent, right? They're looking at the data, we're looking at the data as well, and that informs our outlook for the economy and the risks around the outlook. And we're doing that work in order to get inflation back down. So again, you can have differences. I think, we're doing the best job we can in terms of explaining what we're trying to do and why we think this is a good path to be on in order to get back to price stability. And I do want to underscore that it's very important for the economy to get back to price stability, because leaving inflation at these levels for long is just very costly in terms of the near-term economy, people having to pay those higher prices, but also in the long run. It really distorts decisions that can really affect the economy in the long run. And that will not be good for labor markets in the long run either.
Well, I have one last question for you along those lines. When the market is fighting the Fed like this, they refer back to the so-called Fed put. If the market continues to fight the Fed, who wins?
Well, I don't necessarily see it as a fight. I mean, we take signals from the market because they also are forecasting. And we have very many models and great economists who are working to forecast as well. And when we take all that information, then we set our policy appropriately. So, one of the mechanisms through which monetary policy transmits to the economy is financial conditions. And so that's why we watch them very carefully. But again, I think our job is to be very clear about our intentions, what we're planning to do with policy. And we will be basing our policy depending on where inflation is going and what our forecasts are for inflation and for the labor side of the market. So again, we can be transparent. We're not prescient, obviously, but my hope is that people understand that they see that when the data comes in, we're actually going to respond to it in the appropriate way.